without further ado, then I would just introduce, we have Michael Rowley, President and CEO of Stillwater Critical Minerals. We have Mr. Scott Petzel, President at Metallic Minerals. Greg Johnson, CEO at Metallic Minerals. Tim Johnson, President and CEO of Granite Creek Copper. And as I mentioned, Jeffrey Christian, Managing Director of CPM Group. So I think we would just, Greg, I'll hand it off to you just to do a quick intro of the Metallic Group of companies. You may see the logo there, and then we'll get straight to Jeff.
Excellent. Well, thanks for joining us, everybody, today. Just quickly, we're happy to have Jeffrey joining us from CPM Group to make a few comments on the metal markets, and particularly as we go into the year end. Just by way of introduction, the Metallic Group is a collaboration of 3 separate exploration companies. We started putting this together in the low of the metal price cycle in 2016 through about 2019. Each of the 3 companies is focused in silver, copper, or PGMs and battery metals in high-grade districts with existing or past production. And we've managed to build district-scale land positions in each of these core districts for these 3 separate public companies. We share administrative support teams and technical teams that really allow us to leverage the experience of this group. Myself, many others were part of the original founders at NovaGold, so we bring a great depth in terms of both discovery and development experience to the table with our group of companies. Metallic Minerals, silver and copper focused; Stillwater Critical Minerals, battery and PGM focused; and Granite Creek Copper, gold, silver focused. And so with that brief introduction, go ahead and invite Jeffrey Christian to give us his insights on the metal markets and where we are going into the end of 2022.
And just as a lead off, Jeff, for those that aren't familiar with you or CPM Group, maybe just a quick flyover bio about you and CPM Group.
Okay. Thank you all. And before I get into my bio, I want to thank the Metallic Group and all of its CEOs for inviting me and having the confidence and respect for us to think that this would be a good thing to have on their webinar. I've known Greg and his team for many years, and I've always found them to be excellent people to work with. When we're looking at mining companies ourselves, we're always looking first and foremost at the management and the quality of the management. And we will always be glad to work with companies that are headed by Greg. We've had very good experience with him. I created CPM Group in 1986 when I was running the commodities research group at J. Aron Goldman Sachs. I had been running that for several years at that point and didn't really want to work for them. I wanted to work for myself. And I also thought that research should be independent of buy or sell side entities. And we should, be the product of our company should be research and consulting and knowledge, as opposed to broking and banking and trading. So we set up CPM Group. We've been around really actually since the 70s. We produce the most reliable and accurate data on gold and silver, platinum group metals. We started working on all of those in the 1970s, worked on them through J. Aron and Goldman Sachs days, and we continue to do that. We also do a lot of across commodities research, commodities as an investment, base metals, energy metals, agriculturals, and specialty metals like high purity manganese, molybdenum, tantalum, and vanadium, and other metals like that. So we've been around for a long time. I wrote a book on electric vehicles in the 1970s, which is kind of funny because here I am still talking about electric vehicles, or talking about electric vehicles again, and that'll be very much important. I was asked by the Metallic Group to speak today, first about the macroeconomic and political environment as we see it unfolding in 2023 and beyond, and as we see it affecting the various metals that the Metallic Group is keenly focused on. Obviously, platinum group metals, nickel, copper, gold, silver, cobalt, a variety of metals that will march to two drums. One set of drumming will come from the macroeconomic environment that all metals will live in, and the other one will be the specific fundamentals of each metals market. And I'll talk a little bit about that today. We have been positive on most of these metals for the last several years. There's a certain cyclicality, and there'll be periods of time when we're less positive and say maybe you don't buy in now, but maybe you do if it's a bargain. And then there are times when we're more bullish. If you look at the reasons for that, it has more to do with the macroeconomic and political environment. Now, 2022 started off with financial markets worried about inflation. Inflation was running around 8.2% in the United States, slightly higher in Europe. As the inflation concerns continued, they were added to that was the concerns that interest rates would have to start rising to quell those inflationary pressures, and that could damage both the demand for metals and the overall economy. And that led then to concerns about a recession, an imminent recession. And those things were all sort of hanging over the precious metals and base metals markets in the first quarter of 2022. Then Russia invaded Ukraine and everything sort of changed. And oil prices, which had already been rising from $60 to $90, rose from $90 to $120. And now it's back down to $75. Looking forward, because that's what matters, our expectation is that the quieting of inflation that we've seen over the last 5 months. Yesterday, inflation rates came, CPI for November came out, and it was the 5th month in which headline inflation in the United States was declining. Core inflation, excluding the more volatile golden food and energies, also is declining. And our expectation is that inflation will continue to slowly decline. If core inflation was 6% last month, our expectation is that it might be 4 to 5% by the end of 2023. It's still high, but you're seeing some of the cyclical factors that have been fueling inflation dissipating. There are longer term factors that have been fueling inflation, and those are still there. Employment, the disappearance of workers in many places. 3 years ago, the world was concerned about too many workers. Now it's concerned about not enough workers. The war, Russia's war in the Ukraine, that will continue to be a problem through 2023. And inflation, inflation's not a blob, and it's not something that comes out of a bag as a whole. Inflation is the rising cost of living, and it's actually a composite of many things. Cyclical factors. For example, in 2020, inflation was less than 2% because the world was locked down and people were not spending money and not buying things. In 2021, we came out of that lockdown. People had pent up money, pent up demand. They were buying a lot of things. There were supply chain disruptions because as a consequence of not only the lockdown, but also because of growing tensions between China and most of the rest of the world, especially the United States, but Australia, Europe, Eastern Asian nations, all were having greater concerns about their relationships with China. And that led to a supply disruption. Union workers in the ports of Los Angeles and Long Beach, California, added to the supply disruptions. The fact that you had an 80–90% turnover of long-haul truck drivers in the United States, that was a factor adding to the supply disruption. And we went from being not enough workers to too many workers. And obviously the war in Russia had an immediate, impact on oil and gas prices, on wheat prices, and then a lot of other things as a consequence. That's sort of dissipating. Some of the cyclical factors are dissipating. Some of those secular or long-term factors are still there. So inflation's coming down, but it's going to stay high for a couple years. That means that interest rates are important. And we've seen interest rates rise sharply this year as the Federal Reserve and other central banks have increased their interest rates. trying to quell that inflation. But if you look at a long-term map, a long-term chart of interest rates, the federal funds rate, which is what the Fed increases, actually has risen to the low end of the range of interest rates that we've seen from 2000 into 2021. So interest rates have risen sharply, but they're still very low from a historical basis. We're not concerned that the Fed will throw the country into a recession. We do think there's a recession coming, and I'll speak about that in a minute, but it's not coming because the Fed's raising interest rates. It's coming because of capacity constraints that are spreading throughout the economy, both in the United States and on a global basis. Our view has been that we'll see low growth in 2022 and 2023. We certainly saw low growth in 2022, and we expect to see that continue next year. We don't expect a full-blown recession to emerge until maybe the fourth quarter of 2023, or maybe 2024, or maybe even 2025. And when it comes, interest rates will probably be the least important factor. Macroeconomic supply and demand imbalances in the US and other economies will be the most important factor. And fiscal policies by the US government and other governments will be the second most important factor. We do see a significant recession, 2024, 2025, and that's going to quell demand for industrial metals. It may actually stimulate demand for gold and silver, depending on how financial markets interpret what they're experiencing and what they expect in the future. So we're looking at a market that has seen high prices across all of the metals that I'm talking about: gold, silver, platinum, palladium, rhodium, copper, nickel. Prices have come off in the second half of this year. We had been saying that we thought they would come down in the middle part of the year. We thought that they would be rising by the end of the year, and some of them are in fact beginning to rise. And I'll go through some of the metals relatively quickly now, now that you have an idea of the economic and political environment that we expect. The war is going to continue. Tensions between China and the rest of the world, led by the United States, that's going to continue. Tensions within countries are going to continue. The US has a very divided populace right now, but so does the UK. Scotland wants to have a referendum on leaving the UK and rejoining the EU. Northern Ireland is sort of rumbling about what it wants to do. Within Europe, you have greater divisions. Within China, you have greater divisions, and they've actually started to show up on the television. And then you have Russia. So there are a lot of issues that the world is facing. And some of those issues will be good for metals and some of them will be bad. We have an energy transition that's going to be calling for a lot of copper and nickel and cobalt, metals that metallic group companies will be producing. They may not need it right away, but in 3 or 4 or 5 years, the demand for all of those metals is likely to push the prices for all of those metals higher. If you look at gold to start with, gold people keep talking about how low the gold price is. And it did come down from $2,100 in the first quarter of this year to below $1,600. And it's back up now around 1,800 as we speak in December. But the average price this year is probably going to be $1,804. That's a record gold price. When people ask me, why is the gold price so low? I say, because it's at a record level and because it's already risen. It anticipated a lot of these problems in 2019 and early 2020. And the gold price went from $1,200 to $2,000. And now it's come off into what we consider a consolidation phase. And a lot of the other metals did the same thing, albeit maybe a little bit later. Our expectation is that gold prices will rise modestly in 2023. We're seeing central banks buy more gold, diversify their monetary reserves, probably about 8.5 million ounces, maybe 10 million ounces this year. And investors are buying about 28 million ounces this year. That's down from 40 million ounces in 2020 when the price skyrocketed, but it's much higher than the 20 or 17 or 10 million ounces that you see when the gold price tends to fall. And as I said, our expectation is that if you look at the macroeconomic world of interest rates and inflation and recession and political issues, our expectation is that investors are going to step up their demand for gold over the next several years above 28 million ounces, and that will be reflected in higher prices later, 2024, 2025, 2026. We have a similar view towards silver. We think that, we've seen prices consolidating in the second half of this year. They probably will average a little bit over $21 an ounce this year. It's down from last year, but it's up from $15 and $14 4 years ago. Demand's pretty good. It's good in the solar panel industry. It's good in electronics and batteries. And it's also been pretty good for investment. And like silver, we think that investment demand will rise over the next like gold, we think that silver investment demand will rise over the next few years, and you'll see higher silver prices too. Platinum group metals is more complex. Most of the platinum, palladium, and rhodium are used in auto catalysts, and auto catalysts and auto industry are going through several problems and issues. Within the biggest issue is that you are losing market share to electric vehicles, and electric vehicles may be taking 8 or 10% of the market at present. They will continue to grow, not as fast as a lot of people think, because there are too many constraints on the electric vehicle industry. They can't build vehicles that fast. There's not enough electricity, and the grids couldn't handle the electricity if it existed. So electric vehicles will take market share for the next several years or decades, but it's going to be much slower than a lot of people think. If you look at the International Energy Agency, their expectations are that by 2050, the largest source of energy for humankind will continue to be petroleum, and natural gas will be the second largest. After 2040, renewables will overtake coal as the third largest source of electricity, but coal will still be there. So by 2050, most of the energy that the world is going to be using is going to come from hydrocarbons, petroleum products, natural gas, and coal. And all of those factories and thermal plants and electricity plants and vehicles that use those things are going to need PGMs to clean up their exhaust. So we don't see PGMs going away. There's some gnawing at the edge with electric vehicles taking market share, and that's reducing to some extent the amount of PGMs used by the overall auto industry, even as emission standards continue to tighten, requiring more platinum, palladium, and rhodium per vehicle. Within that, you have a cyclical decline in auto production and sales over the last few years, starting with the lockdown and then the supply chain problems in 21 and 2022. That's going to get behind us. A recession may slow down the recovery in the auto industry, but the auto industry is going to continue to grow. There are people who think we've reached peak auto, that we will never produce as many light-duty vehicles as we did in 2018, 2019. CPM Group doesn't agree with that, as do most other entities, including the International Energy Agency and pretty much most of the auto industry. So we're still going to be using vehicles. And then within that, you have been seeing a shift away from palladium intensity toward using more platinum and less palladium. You're not getting rid of the palladium, you're using less palladium relative to the amount of platinum. And that reflects the price differential. And it's going to probably continue for a few years until perhaps platinum prices become higher than palladium prices, at which point the auto industry may start to shift back to using more palladium at the expense of platinum. But for the next several years, we see this shift away from palladium and rhodium toward using more platinum. They're not going to stop using palladium and rhodium, but the prices will remain for rhodium probably around where they are now or a little bit higher. And when I say a little bit higher, I mean like 30–40% higher than they are right now. Palladium prices probably have a little bit more to go down, and platinum prices have a lot more to go up. So we think that you'll see a greater portion of the market price and market revenue basket for PGM producers coming from platinum over the next several years, if not the next decade, than from palladium. That's that. Copper, we like copper. There's been a big deficit this year. It's going to be probably a smaller deficit next year. And if we have a recession in 2024, it could be a surplus for a time. But beyond 2024, the energy transition is in fact going to need a lot more copper. And you're going to have to see copper produced both from new mines and from secondary recovery of old scrap. And that is going to be a slow process. So the prospect that copper price is going to rise beyond 2024 are very high. So we're long-term bullish on copper and copper companies, especially companies that will be producing 2 or 3 years from now or beyond that. And nickel is in a similar situation. We run various scenarios on batteries, and one of the constraints to how fast electric vehicles will come in are uncertainties over which battery technology is going to be used. But one thing is clear across almost all of the battery technologies currently being looked at and having promise for the next 10, 20, 30 years, nickel probably will be the biggest winner in terms of increases in demand from battery and electric vehicle manufacturing. So we have great expectations for nickel prices in the long run. Next year might see some weakness in the nickel price, partly because nickel prices have been so high in the last year or two, and they have come down, and they may come down a little bit more. But that's a cyclical dip, in our view, in a secular bull market. We expect nickel prices and copper prices and platinum prices and gold and silver prices to be much higher beyond 2023. I've probably spoken longer than I should have, so I'll give the microphone back over to Chris.
No, on the contrary, Jeff, that was an excellent and thorough overview. I think we were probably being unrealistic, you and I, when we were chatting about a 10 to 15 minute coverage after I gave you a list of these huge things to talk about. Really, I mean, a great and comprehensive overview. I know that we had a couple of questions, or at least Scott, Tim, Greg, and Mike likely did. I'm not sure who wants to jump in first on that. I guess maybe I will, just to get started real quick, and we won't keep you long, Jeff. I know you have to go. But critical minerals, domestic supply. I mean, it's just everywhere, including in Stillwater's domain name. But you've seen just recent announcements, critical mineral strategy in Canada. You've seen the Infrastructure Act in the US with these critical minerals defined and so on. So what impact is that going to have on maybe on which projects are beneficiaries of these pushes and so on?
I think it's going to be a positive factor, and it's something that we've looked at CPM Group really for several years. The idea that you can be dependent on a global supply chain is great in theory, you know, the brotherhood of mankind and all, but it hasn't played out well over the last 6 millennia. And what we're seeing in the last 2 years really is a realization of that you probably have to pay attention to where you're getting your supplies, your raw materials like metals, but also where you're manufacturing and semi-processing and manufacturing the products that you make with them. And as a result, you're going to see a lot of people saying, I want either a home base or I want a stable base. And one of the things, people in North America, Canadians probably more than US citizens. US citizens like to think that the United States has a whole lot of problems, and we do. And Canadians probably think we have even more problems than we do. But the reality is that the US and Canada have an enormous competitive advantage politically, economically, socially, culturally to most other parts of the world. So I do think that you guys are in the right jurisdictions in terms of raw material production, not only for Canadian and US companies and government policy, but also for the policies of other countries, including Europe and including some countries in Asia and Africa. Because, it's like, okay, we're seeing it right now with some of our clients that, they're saying, okay, we can mine raw materials in various jurisdictions, but they have a greater political risk and they have a greater degree of uncertainty of surety of supply. And so what we're seeing is that not only do US and Canadian companies say US and Canada are the place to focus, but you're seeing other countries say the US and Canada are the place to focus. So I think that is good for your industry. And it's also probably a positive for both the US dollar and the Canadian dollar in the long run, because these people will need US and Canadian dollars in order to invest in mining companies, processing plants, semi-fabricators and fabricators. And a lot of those probably will be in our two countries.
Guys, Greg, Scott, Tim, Mike.
Sure, I can jump in. So Jeff, you said in your introduction that you formerly were with Goldman Sachs. I put you on the spot here a little bit. Goldman Sachs came out recently with some very bullish copper price predictions, including hitting $5 US next year. That's probably a little bit more bullish than where you sit, but they also predicted seeing up to 540 in 2024. So the question is Goldman Sachs sort of flight of fancy prone? Is there a reality pin that we can put in this, or are we going to see other firms like that start to predict those very bullish prices, which we appreciate?
I should have badmouthed Goldman Sachs, but they used to have they used to have a fabulous commodities research group 40 years ago, and they replaced it with a group that primarily looks at price momentum indicators. They don't necessarily have a very strong basis in the fundamentals of mining production and secondary supply and fabrication demand and investment demand and inventories, and we do. And I'll hold our track record up to not only theirs, but other people's track records in calling these markets. We have a very good record, not only calling the directions, but also turning points, which is really the critical thing. Mm-hmm. I think Goldman is a little bit too bullish. If you factor in issues like low growth in industrial production, lower growth in industrial production, the possibility of a recession. The OECD thinks that the US will see 2 quarters of negative 0.1% growth in 2023. That's basically flat growth. If you factor in those kinds of economic factors, as well as the fundamentals of a contracting deficit in the copper, I think it'd be pretty hard to push prices that far higher. I don't think they're going to fall that much further. And then I think they're going to move sideways. But that just may be too optimistic of a view.
I think the one comment in that report that was constructive, though, in a real situation we see in the industry was I think Goldman was pointing to the reduction in some of the production figures for some of the major miners, particularly in copper. And, that's a reality the industry faces. We don't have a lot of big new mines coming on stream. A lot of the biggest mines are old and seeing declining grades. And so this really is an issue in this industry. I guess timing of when those factors start to come in is a point for argument. But, the industry does need to find new deposits to bring into production to meet these very strong growth projections for things like you said, EV and just general economic development, particularly in the developing world.
I do agree with that. And from a long-term perspective, we do see prices moving higher for sure. But I'm just not quite sure that we're going to see it in 2023.
Well, the prices have been pretty strong. So even if we stay more or less flat here, I think it's good for our sector. I mean, we're comfortable with these prices and look forward to being even higher.
Look, if you can't mine copper profitably at $7,000 a ton or $360, $3.68 a pound, you probably shouldn't be a copper miner.
Yeah. Good point.
I'd say the same for nickel as well, at $13 a pound right now versus $9 where it started the year. Similar.
Yeah,
context.
absolutely.
Jeff, I got a quick question for you. You said silver demand has been good. This is really on the precious metals, but silver demand has been good. Investment demand has risen. We've seen silver price as low as 18 at the end of August, and we're up around $24 an ounce right now for silver. It's outpaced gold price increases, and so that gold silver price ratio has decreased significantly, which spiked in early 2020 at the onset of the pandemic, and has really trended lower since September, and we're around, I think, 77 to 1 right now. What's the implication of that for investors? And one of the things I think we can see too, maybe you can comment on, is that with this price increase from 18 to 24 since August on the silver price, that the mid-tier producers are starting to get a bit of a bump, but we haven't seen that yet in the junior explorers. And I'm hopeful, and I think it will sort of tend to pull us up in that regard. So what are your thoughts on the implications of the decreasing ratio between gold and silver for investors? And do you think the junior explorers are going to get a bump here, tagging along with the mid-tier producers on increasing silver and gold prices?
Well, first, I see the gold silver ratio as a barometer of realities in the gold and silver markets. And what you're seeing is that there are, in fact, investors shifting their focus away from gold towards silver. And as you said, really starting with the onset of the pandemic and the lockdown, gold has been the preeminent focus of many precious metals investors. And you're now seeing people shift away from that and focus more on silver. And I do think that there is a trickling down the ladder. And so, mining, investors will say, well, what silver mining companies do I look at? What new silver mining companies or junior silver minings do I look at? What exploration companies that are on the horizon do I look at? And that's really one of the strengths that Metallic Minerals has, is your management. Because again, you can find a lot of companies with good deposits, but management that just can't move them forward. You guys have good deposits, and you've got a management with proven track record for moving projects forward. So I think that as you see the markets continue over the course of 2023, and especially in 2024, you will see investors start to refocus on future production sources and exploration. And partly, as Greg said, some of these bigger companies it's a depleting resource. They're having trouble finding replacement reserves as fast as they're mining. So I do think that you'll see that coming. And we do think that, silver prices will outperform gold prices in terms of percentage increase on an annual average basis, and probably from trough to high over the course of 2023. And that trend probably will continue into 2024.
Mike, I know you had a couple of things on your mind.
Well, you've actually covered them off pretty nicely with your bullish sentiment on nickel there. Thank you, Jeff. But just to reiterate, nickel's performed very nicely over 2022. and physical supplies of the metal, multi-year lows for it and copper and a bunch of other commodities. Maybe you could comment on that, and also the importance of nickel sulfide. Our project, of course, Stillwater, nickel sulfide in the US, and what that means for supply as well.
Well, yeah, again, what was the first part of your question?
It was a bit of you've covered a lot of it off actually in your earlier. So yeah, physical supply, the stores of the metals right now.
Yeah, nickel's an interesting metal because it's one of those things that if you look at reserves and resources, you say, oh, there's all this stuff out there, but a lot of it not necessarily easily mined or easily processed once it's mined, and easily converted into nickel metal, or it has impurities that kind of make it less attractive for battery manufacturers ultimately to go. So if you're dealing with nickel sulfide, you've got a leg up. If you're dealing with metal in North America, you've got a leg up, because a lot of the other stuff is laterites and they have impurities, and they're in Southeast Asia. They have to be shipped, and they have to be shipped carefully because they take on water and cause ships to sink too easily. So there are a whole lot of issues there that have positive implications for your properties in North America. Yeah.
Music to our ears. Yeah.
Mm-hmm.
That's why we're there.
I think that's got it covered. We can probably, Jeff, we can probably let you go with immense thanks, unless anyone else has a follow-up before we do. Okay.
It's great having you, Jeff. Thanks for taking part in our year-end opportunity in junior mining's webinar here. Really great to see you, and thanks for all your words and encouragement.
Well, thanks for inviting me, and thanks for having enough respect for CPM Group and our work to invite us. And yeah, I look forward to working with you guys in 2023 and beyond.
And just before you do go, Jeff, it's probably a good time. CPM Group and Jeff have been good enough to offer a discount on the silver yearbook, the gold yearbook, or the PGE yearbook that CPM famously publishes each year. So we have a promo code for those interested in a 50% discount on those. Promo code, of course, is M Group, capital M, capital G, lowercase Group. I'll put that in the chat window for everyone to look at. That is good until the end of the year, till the 31st.
Sure.
And I will also put the link to the CPM Group store. Great publications, more info than you can imagine, and obviously the best game in town when it comes to commodities research and so on. So thanks, Jeff. Thanks, Elliot, for that generous offer.
You're welcome. Have a good year.
And have a great holiday, Jeff. We'll obviously be speaking soon, but maybe we won't see you until the new year.
Take care.
Thanks, Jeff.
Yeah, thanks,
Bye.
Jeff.
Thank you, Jeff.
Take care.
Okay, that link and promo code is now in the chat window for you. And we will chat now about the Metallic Group and the individual company updates. I'm just going to share my screen here. Bear with me as I make the PowerPoint full screen. There we go. And Greg, I will hand it off to you as chair of the Metallic Group. We were going to get started with a little bit of background and cycles talking about timing of investing in commodities, mining, and juniors.
Excellent. Yeah, so building on some of the points that Jeff Christian made so nicely, one of the important factors in considering investment in the mining space is really understanding where you are in the bigger picture commodities. What's nice about this chart, which is an ultra long chart, you're looking at, basically 50 plus years of metal price cycles. This is showing the S&P GSI total return commodity index divided by the S&P 500 stock. So you're basically looking at commodities versus equities. And it really nicely highlights these cycles, which tend to be 6 to 10 years in length, from trough to peak. The last one ran from 99, 2001 was the low period, 2010, 2012 was the high. And as you can see from this chart, we're just starting to leave the trough period, which has been going on since about 2016 on this cycle. So a bit more of a prolonged trough period, but we're well below the long-term median on this, and really highlighting what an exceptional opportunity commodities are in the current marketplace. If we dive into the next chart to look at the last cycle and break apart the components in this, you can basically see that Goldman Sachs Commodity Index has three subcomponents: base metals, energy, and precious metals, shown in the three colors here. And what you can see is that though they have slightly different patterns, as a whole, they are moving together as a broader cycle. You can see the low back in that 99-2001 period. You can see the multi-year high period there from particularly 2010 to about 2012. The extreme bear market drop that we've been going through since 2012, and new lows in the cycle, as Jeff mentioned. It looks like we put in lows back in 2019, as well as here in recently in 2022, that may be the ultimate lows in the cycle, and that we're at the very beginning phases of what looks like could be a strong move upward in relative value of commodities versus the general market. And this provides an excellent opportunity for investors to be buying in during a rising phase of these commodity cycles, which, as I said, tend to run 6 to 10 years in length. So we're in early innings on this. It's an excellent opportunity to be looking at the sector in general. And as we switch to the next chart, one of the opportunities, in addition to riding the broader metal price cycle, is understanding in your investment opportunities, where do I want to invest in terms of what stage companies? And in the mining space, we see a number of avenues for investment. You can invest in the producers. Producing companies typically trade with the metal price and with their individual growth prospects. But there's a couple of really exciting opportunities for higher returns through the exploration process that investors can enjoy. And if you look particularly at this chart that's sometimes referred to as the Lassonde curve, there's a couple of sweet spots on this curve for earlier investors who are looking for greater returns, the opportunity not just to see, a few percent return on an investment, but potentially multiples on your investment. And those opportunities happen to be right where our metallic group companies, Metallic Minerals, Stillwater Critical Minerals, and Granite Creek are today. The first part of that curve is the opportunity to invest in things as they move from exploration stage, when they're at their lowest valuations, to resource definition stage. And both Metallic Minerals and Stillwater Critical Minerals are at this stage, having tabled their first resources in the last year. They are now in the growth phase, drilling, expanding those resources. Granite Creek Copper has quickly moved from exploration stage to actually not only an expanding resource, but are in process right now with an upcoming PEA update, which will be the first engineering study to really highlight value. And as you can see, both of these two areas are excellent opportunity for deep value to invest in companies as they start to not only increase with rising metal prices, but increase via de-risking, expanding resources, and driving these assets towards production. So with that introduction, we're going to take a couple of minutes to just highlight some of the major milestones and catalysts in each of the three metallic group companies. And I think Chris will probably kick it off with Scott and Metallic Minerals.
All right, great. I have a half an hour, right? Oh, maybe not. So let's strap in. It'll be a quick 2 minutes highlight of the Metallic Minerals Corporation. Metallic Minerals is a precious and base metal focused growth stage exploration development company with two key assets and an alluvial royalty portfolio. Our first key asset is our Keno Silver Project in the central part of the Yukon Territory in Canada, where we're exploring and working to develop resources on the Keno Silver Project, which is a silver lead zinc project. It's historically produced over 200 million ounces of silver and currently has a resource base in the district held by Hecla Mining of 120 million ounces. Our second key project is our La Plata project in southwestern Colorado. It's a silver, copper, gold project, porphyry system surrounded by high-grade epithermal gold, silver telluride veins. We consolidated 2/3 of the district on the backs of work done by the majors in the 50s through the 70s. It included Rio Tinto and Freeport. We've been able to come out with an inaugural resource of nearly 1 billion pounds of copper that includes 15 million ounces of silver. And on both of these projects, in 2023, we had modest exploration programs, particularly at Keno. We drilled roughly 3,200 meters of diamond core drilling on the project, completed LiDAR surveys to help us advance 5 distinct targets towards a resource base, including the discovery and advancement of our Fox target, where we see something a little different and new in the district, which is bulk mineable zones of mineralization, potentially up to 177 meters wide from recent drilling. On our La Plata project, we drilled a couple of holes to offset our newly announced resource from April 22. And we look forward to having an expanded resource calculation in 2023. As catalysts for the company, both of these projects should have results coming due in the early part of January, and we'll be looking forward to announce those, followed by the potential for an inaugural resource announcement at our Keno Silver project, and this expanded resource announcement on our La Plata project, both in sometime in 2023, hopefully. And I think that covers the highlights. If there's anything I've missed, please chime in there, Greg or Chris.
Yeah, absolutely. I think that's a good overview, and I would invite participants to jump into the Q&A if there's any specific questions about either the programs, the projects, what's coming, and timing and so on. I think that's a great format for that. And we can jump to Tim Johnson of Granite Creek Copper.
Great. Thank you, Chris. Thank you, everybody, for taking the time. We'll briefly touch on Granite Creek's Carmax Copper Project. 100% owned. We're located in central Yukon with excellent infrastructure. Our project is within 15 kilometers of hydroelectric grid power. We're within 40 kilometers of paved highway, and we access through an all-weather road maintained by the Yukon government. Big takeaway I want people to take from today is that, as Greg mentioned, we are updating a preliminary economic assessment. We're in the late stages of that. We're putting the finishing touches on it, working with SGS Canada on getting that completed, and we'll be delivering that to the market first quarter of next year. Now, this PEA is an update from a 2017 PEA, but it's an entirely different project. The 2017 PEA only looked at a small portion of the oxide ore present at Carmax, where we're looking at not only all the oxide ore, but sulfide ore that we identified in our inaugural drill program in 2021. And in fact, one season of drilling allowed us to increase the measured and indicated contained copper on our project by over 43%. And we've got multiple untested drill targets, not only in and around the proposed pits that are the subject of the PEA, but on quite a bit of the other portion of our land package. We've got a very underexplored land package, and we've been very successful in our initial drilling and surveys on there. So again, I would encourage you to add us to your watch list and watch for that PEA, which we hope, knock on wood, would be a major revaluation for the company. It's going to be a much larger resource that is being inputted into that PEA. Again, both oxide and sulfide ore, simplified flow sheet, and moving that to be delivered early in 2023, and then onwards and upwards from there. Again, as Chris mentioned, if there are any questions about the project, feel free to add those to the Q&A, and we'll do our best to answer those after we've heard from Mr. Michael Rowley and the Stillwater Critical Minerals project.
Yeah, Stillwater Critical Minerals, 3 district scale assets. We were acquiring things through that bear market cycle per the Metallic Group model. The focus very much on Stillwater West in the past year and looking forward as well. To that end, we actually renamed the company around this asset in the past year. We also signed a deal on the Ontario Gold Project, which now has us with a 12% share position in a new listing, and we're excited to have that exposure to the gold space. The vision here is to become a primary low carbon source of battery and precious metals. We're doing that in a famously productive US district, essentially bringing the 3rd wave of critical mineral supply to the Stillwater igneous complex. We share these great rocks with Sibanye Stillwater. These are arguably the best rocks in the Western Hemisphere for our target commodities. And we're bringing in the South African geologic models. And that's a key point in our work here as we look to expand those 2021 resources that are presented at the bottom of the screen. 1.1 billion pounds, nickel, copper, cobalt, 2.4 million ounces, palladium, platinum, rhodium, and gold. That's a good segue to the next slide there, Chris. That was one of the key events of the past year for us, was bringing in 2 geologists from Ivanhoe. Dr. Danny Grobler, former chief geologist of Ivanhoe's Platte Reef project, and Albie Britz as well as senior geologist. The key connection here is that these guys have 20 years each of experience on Ivanhoe's Platte Reef project. Well over 100 million ounces PGEs, 4 billion pounds nickel, copper in this big bulk mineable sulfide system. That is our target geology at Stillwater, and that's why that was a key milestone for this year, is to bring those guys in. We're looking forward to them guiding our expansion on that 2021 resource, and that, as listed here, is a key upcoming catalyst. That was a key objective. Resource expansion was a key objective for the year, and I'm pleased to report that the models look great. They're coming together nicely, and we are in good shape to report those, I think, early in Q1 in January of 2023. Aside from team and the expanded resource estimate, we are doing good work with the US Geological Survey. And of course, 8 of our commodities are listed as critical now by the US government. There's a lot of government spending increasing available for exploration to secure domestic supplies of these commodities. And we're looking forward to reporting on that expanded involvement by the US government in incoming news releases. 2022 exploration results are another catalyst in the near term here. We did some programs in 2022 that we're very proud of, and we're looking forward to reporting on those results, including the integration of that Platte Reef geologic model into our predictive geologic model of the Stillwater complex. It's not mentioned here, but we are in some good discussions towards deals on the Kluane asset in the Yukon. Very large land position, critical metal focus. That is moving nicely as we look to focus further on the Stillwater asset. Going forward in 2023, you'll see us continue to work to expand the resource at Stillwater. With Danny and Albie on board, we feel very good about our ability to expand further 100-meter step outs on those 5 deposit areas, and then also some farther step outs as well into new targets. These will be our first programs with that Platte Reef model fully integrated into the geology. So that's exciting to us. We're funded through the near term, we're permitted, and we're looking forward to our biggest season yet in 2023. Thanks, Chris.
Thank you. And thank Scott, Greg, and Tim as well. So we're coming to, spoken about the companies. We've invited some questions for the Q&A, and I know there was a couple more things to just chat about on the opportunity side. Greg, we could jump into that year-end opportunity and the GDXJ and SILJ chart, or we could jump right to some Q&A.
Why don't we just quickly show the chart and then we can open it up for questions.
Sure.
So as you can see from the presentations from Scott, Tim, and Mike, all three companies have been employing this common strategy in the Metallic Group of delineating, acquiring district scale opportunities that have potential for tier one assets. We've come a long ways over the last several years of putting these land packages together next door to, amazingly, in each case, one of the world's highest grade silver producers, one of the world's highest grade copper producers, and one of the world's highest grade PGM producers. So the land package is really unrivaled in these iconic districts. Advancing these models, which we believe have the potential to be tier one in size that the majors are interested in, and moving to first resources within the last 12 months and de-risking these assets. So we're really proud of the work to date. One of the surprising things when you look at the cycle and you look at the sector, as Jeff Christian mentioned early on, we've been in a consolidation phase in the silver market for the last 2 years, and really for more than a year in the base metal market. And so that's really presented an opportunity here. This is a relative performance chart showing you the GDXJ, which is the Junior Gold Producers Index, the SILJ, which is the Junior Silver Producers Index, and then the CDNX, which is the Toronto Venture Index, which is the microcap explorer developer index. And what you can see is with the bounce in silver, gold, base metals that we've seen here over the last few weeks, we've seen those mid cap and large cap producers start to move back up. They're putting in higher highs, higher lows. It looks like we probably have put in the low for the recent cycle. The juniors, however, as a basket, there's some 1,800 listed resource names in the venture index, have continued to trade sideways. They're near their lows right now. We've seen almost an unprecedented level of year-end trading in the juniors. And I think this has kind of overwhelmed some of the volumes on these smaller names. And yet, as you can see in the fundamentals in the Metallic Group names specifically, these companies are poised for growth and for shareholder value creation. And so this is an opportunity for astute investors to recognize as we go into this year end and whatever year end tax related selling and trading may be going on, you've got a great opportunity in the junior space to take advantage of, particularly with the bullish fundamentals for metals as we've laid it out. So with that last kind of opportunity point, Chris, why don't we go ahead and open it up if you've got some questions from the Q&A?
Absolutely, we do. And there's where to start. Okay. We'll start with one from Metallic, and I'll bundle these two because there's some overlap here. The one is what are the plans for 2023, and the other is a little more fleshed out with the markets don't seem to reward two flagship projects, so perhaps you need to focus and to keep dilution at a tolerable level on one project. What will be the focus on for 2023 and beyond?
So maybe I'll take the second part of that question first, and Scott, maybe you can address the plans for next year. Our experience at NovaGold was, in fact, the market will reward multiple projects. We had both Donlin, which was gold focused, and Galore, which was copper gold. And over time, we went from a micro cap company back in the bottom of the last metal price cycle, $10 million market cap, to over $2 billion in market cap value. And most analysts were giving us $1 billion for Donlin and $1 billion for Galore. So in fact, in the right market, demonstrating real value, you can really be able to table value for shareholders in there. And we're in the very early days of that process with all three of the Metallic Group companies, but particularly with Metallic Minerals, with the twin kind of flagships. And we see the opportunity with a resource already at La Plata and a soon to be delivered resource in 2023 at Keno to be able to move these. And as the market starts to once again price in value for the explorer developers, to really be an opportunity for investors here. Scott, do you want to dive in terms of the details on some of the plans for 2023?
You're muted, Scott.
You're still muted.
Sorry, Scott, that was my fault.
How about now? There we go.
There we
now
go.
we got you.
All right. Good deal.
Much better.
I was just going to say, I agree with Greg's comments, and I think the market will reward us ultimately for having these two really significant assets as we move them forward. And not only that, we have the capacity and the ability and the experience to do that simultaneously and find that value. And so really you think about where the projects are in the sense of established resource at La Plata that has really infinite room to grow, not only with respect to the current resource that is really largely just drill defined at this point, or the drilling that exists limits the extent of the resource model for the most part. So we have the ability to really expand that resource. We also have 16 untested targets that represent potential porphyry copper centers of more copper and silver gold mineralization that we haven't drilled yet. And we're finally in a position where I think we can do that moving forward on that project in 2023. At La Plata or at Keno, as Greg mentioned, and I mentioned previously, we're really on the cusp of coming out with a new inaugural resource on the project sometime during the year. And I think that will be a significant driver of value for us on that project. But our plans would be to continue. I think we're really in a sweet spot right now where we come out with an inaugural resource. We've demonstrated the ability to define areas that have resource potential, and that now we can really put some drill holes into those grounds to grow those resources rapidly. But at the same time, we've got 21 undrilled target areas that we haven't tested by drilling yet. We've got another 11 that have positive results from drilling that we need to follow up on, as well as the 5 target areas that we're working towards resources on. So I think you'll see an effort really focused on resource expansion following the initial resource at Keno, but a continued effort to make sure we understand what the district is, and we're going to test some of these other targets as well.
It's worth noting too, with Hecla's takeover of Alexco, this is going to be a big year for the Keno Hill Silver District. We anticipate Hecla space. So this is a great time for us to be adjacent to that asset as it comes back on stream under the banner of Hecla Mining.
Since we're on a bit of a roll with metallic, you answered this part of this question. When do you plan to generate an initial resource estimate at Keno? The second part of that is how many meters do you need to drill for these areas? And I guess that's probably just a good jumping off point to talk about the scale potential at Keno, and maybe with the western part held by Hecla as kind of a comparison.
Well, I think a quick answer to that is how big do you want the resource to be? Just the potential is great there. We've talked about this at some level being the potential for a 1 billion silver ounce district. Right now, 220 million ounces historically mined, 120 million ounces in current reserves and resources at Hecla. And the prospects are really great. And I think one thing that we have the ability to do now, that we have largely dedicated a fair bit of exploration on the east end of the district. And since applying the systematic exploration out there, made this discovery at this Fox target, which represents sort of a new style of mineralization, which is a sheeted vein zone. Like I mentioned earlier, up to 177 meters wide. These generally have pretty high values. They're very shallow dipping, and we may have the ability to really quickly add resources with drilling there as we move forward. And we're able to see not only what we've done at Fox, but now starting to recognize that these types of potentially bulk mineable deposits are elsewhere on the project and require follow-up. So really the amount of drilling that we could do is endless. And we'll take what we get and continue to move these resources forward. And I'm sure that as we move out of 2023 resource expansion towards, say, 100 million ounce resource base at some point for metallic would be a goal.
Tim, I'm going to toss this one over to you. The question is, it's geared towards battery metals, but I think copper as a key component in the electrification. I think we can speak to that as well. So the question, I'll just read it, is what is the predicted impact of deglobalization in times of decarbonization on battery metal demand and prices? I think you could probably just include the critical minerals in that.
No, that is a good question. I mean, I think, 10, 15 years ago, everybody looked to what China's doing, and that was the benchmark of where metal prices were going to go. And as we deglobalize and we have countries sort of onshoring production and keeping their own production, I think it's going to have a positive effect on metal prices. And it's also going to sort of decouple us from having to look to China all the time as to, where the markets are going, where metal prices are going. And I think that's a good thing. I think, having the production sort of distributed and having countries bringing their own production and manufacturing onshore will be good. It'll help with supply chain issues. But again, it should have a positive effect on metal prices because you don't have one centralized producer or manufacturing anymore. It's going to be more distributed.
Yeah, I think that's right. And when you talk about things like sourcing some of the metals from far overseas or distant places, or having it even smelted or refined there, if you can take some of that, the shipping back and forth of concentrates or the materials over and then back and so on, I think that streamlines supply chains, like you were saying. It's actually a good jumping off point for a question that I'll toss over to Mike, and I'll also take the opportunity to expand it a little bit. But the question as read is, with Ottawa's recent announcement with regards to critical mineral strategy, how could this benefit Stillwater Critical Minerals business operations in Canada? But I think we can probably expand that answer, Mike, to include the US as well. So we do have assets here in Canada, but I think this broader critical minerals push is worth just a comment on.
Yeah, absolutely. And I was going to go there that the US is now funding projects in Canada. So
including the Department of Defense.
Yes. So yeah, we have the Kluane project. It's a wonderful big piece of ground, 255 square kilometers in a district that's known for deposits of critical minerals. And we're currently, as a board and with some outsiders as well, talking about options on that, and very interested in these increased government initiatives towards critical mineral funding for these. And that will weigh into our plans for the Kluane project in the coming year. I'm going to back up a bit to the previous question too, and just note that we've got mining companies reporting their metal now in a carbon footprint basis, which I think is really good in terms of if you've got this North American audience that is a little more selective and is paying attention now to where their metals are coming from. Nickel, of course, produced in Indonesia from laterite ores is an order of magnitude higher carbon footprint per ton of nickel. It's really good for mining companies to start reporting it this way, and that brings production back to North America and a focus on that overall footprint.
I think just one thing to add there too, just on there's a slight difference at the moment in Canada. Copper is considered a critical mineral, whereas it's not on that critical minerals list in the US. But from everything I've read, including very recently, as recently as last week, the expectation is that copper will indeed be added to that US critical minerals list. So that's something to watch out for as well.
The US is starting to realize what it means to update their infrastructure, their grid, right? It's out of date. And if everybody's going to go electric, it needs a lot of copper. And Friedland's been saying that very eloquently, but it's there for all of us, right? Yeah,
Well, if I can just
absolutely.
comment on that quickly too, is, you mentioned the critical minerals. A lot of times we internally refer to metallic minerals as an electric metals company because we have the best conductors. We've got silver, we've got gold, we've got copper. But on the critical minerals front, specifically thinking about the La Plata project, is we're working towards a collaboration right now with the USGS through their Earth MRI program, like Mike is doing at Stillwater, and the Colorado Geological Survey, to focus on the La Plata project as a potential for a critical mineral producer. And the reason is, as I mentioned earlier, there's a lot of telluride in the system. Telluride is a very important metal, not only in the, the sort of, I guess, the semiconductor, but the solar panels and things like that as well. And it is on the critical mineral list. But we also have the potential at La Plata to explore for vanadium, rare earth elements, and PGE kicks that we've seen in some of the resampling that we've done from historic cores. So we're excited about the collaboration. Strategic or critical minerals is also part of the metallic minerals story as well.
Okay, so just a quick update from the news of the world, and that is that the FOMC officially announced a 50 basis point rate hike minutes ago. So
so you win that bet.
yeah, me and many others. Just quickly, Scott, and you may have mentioned this, but just to reiterate, which targets at Keno would be expected to deliver that initial resource in 2023?
Well, we're looking at 5 different targets. The 2 primary drivers of the resource work will be our Caribou target, which is the one in the picture behind us, where we've got over 70, I think 5 pierce points now into the deposit. And we're seeing both kind of a hybrid, narrow, high-grade target, as well as maybe a more broad sort of 20-meter type scale and a very shallow dip. Formo would be our other target area in the west part of the Keno district. And then, of course, our new discovery at Fox and the oldies but goodies standards of Homestake, where we've drilled in the past as a potential 4th target, and our new acquisition at Nabob that we completed in 2022 as a potential 5th resource target for our work here in 2023.
Okay, there are just a couple more questions that I think we can knock out relatively quick. Greg, I'll direct this one to you. Alluvial projects. We haven't really talked much about it, but an exciting and very different or a differentiator, I suppose, with metallic minerals. Maybe a few words on that. The question is, what can we expect from the alluvial projects?
Yeah, so this has been something that's been building over the last couple of years. We have a very large land package in the Klondike, which has produced over 20 million ounces of alluvial gold. Today, it's not guys with a mule and a pan for gold, but it's large scale open pit mining, but very simple because you don't need to use any chemicals. We've got a large land package. It's permitted for mining. We have groups that have been doing exploration and test work, and we are in the process right now of potentially negotiating some new agreements there. So we hope in the new year to have some announcements on moving that forward, with the opportunity that Metallic could actually take actual production royalties anywhere from 10 to 15% on those lands. This is a differentiator. It's not common in the junior space to have near-term production, but it's a real opportunity in these assets because they can get permitted in some cases in less than 6 months. The capital cost for these producers is quite modest. So Metallic is moving forward with this as an opportunity to be able to generate cash flow and production from gold on our holdings in Utah. Okay,
3 more questions, and I'm going to knock out 2 of them because they're more or less, well, will there be a replay available? Yes, absolutely. We will get the recording. We will brush it up so it's presentable, and we'll have that on our YouTube channel. We will send out a link via our social media and email blasts, so you can watch out for that. Actually, a really good question just came in, so sorry. Let me this other one. So Stillwater is one of maybe just 3 of the greatest complexes globally, and the only one in these Western countries. How to gather more attention to this fact. We're working on it. We have a few things up our sleeve that you'll see in the early part of 2023. I think we've set a good base, and the bringing on of Dr. Grobler and Albie Britz has kind of made this a bit more of an international story that some big eyes are on.
Yeah.
All of the majors are well aware of us, and we're doing a lot more of attention bringing. So I think that that's well in progress, and you know, the more we continue to get out there and tell the story, the bigger it gets, and so on.
Just to add a bit to that, building on Greg's slides there, that the past 6 months really hasn't been the time to get any story out. Good news is rewarded with selling, right? We're just out of that now in the past maybe month or 2. So yes, you're right. The initiatives we have underway, the additions to the team, the bigger resource, all that will bring the proper attention. The district's known for PGEs as well, and we're having to shift that attention to include that basket that is now 50% nickel, and that's new to people. Anyways, that's my take on that.
Yeah, and it's actually a good decent segue to the question that just popped in, which was auto companies appear to be actively looking to secure battery metal supplies by offtake agreements with mining companies, or even taking shareholdings. Do you see more of this happening, and might you become involved?
Yes.
Absolutely.
They typically don't enter at the stage of an inferred resource, right? But as you mentioned, we have got a lot of big eyes upon us, and it's going the right way. And given how short the list is of companies that could do this, you know, especially nickel space has been starved out for exploration in North America. Yes, absolutely. We're open to all those things, and there are even some conversations underway towards that. Yeah.
Okay, and I saved this one for the end, given that it's approaching the holiday season of goodwill and cheer. And I always like a good battle royale. So which of the 3 companies in the group do you see having the greatest growth in 2023?
Well, I think the amazing thing about our group is all 3 companies have gone from exploration stage 12 plus months ago to first resources. And in the case of Granite, you know, we're going to be delivering this updated PEA. So each of them have got their own metal of focus, as we've talked about. These metals, the fundamentals, as Jeff Christian emphasized, look fantastic in the medium to longer term. It's a great opportunity in the marketplace today for juniors. And each of these companies is going to be expanding resources and moving towards de-risking. So it's a great opportunity to get a diversified basket exposure to these electric metals and precious metals in the group. And we would invite anyone who'd like to go into more detail on any of the 3 companies to give us a shout, drop us an email on the websites. We're always happy to speak with existing shareholders or interested new investors. So I think, Chris, with that, really appreciate everyone joining us today, and thank you very much for your interest, and have a great holiday season. And we look forward to delivering exciting catalysts in 2023 for the group of companies.
Yeah, thank you. Thank you, everybody.
Exactly. Thank you. And I'll just remind you, the promo code is MGroup. Go to cpmgroup.com/store to get your 50% discount off one of those yearbooks. And thanks, gentlemen. Thanks, everyone.